Holy smokes, folks. What can I say? I mean, it's worth looking at here. We're talking about CarMax today. Why am I talking about it? Well, they just reported earnings pre-market, and this stinker is down 10.9%. This is a huge move. We love talking about big moves in the market. This one got a butt whooping today from this earnings. So let's take a peek as far as these earnings are considered and see what we're seeing. So GAAP EPS of $1.72 is a miss by 17 cents. Obviously not ideal, but I think there's a lot of reasons for a potential EPS miss for this company. Big issue right now overall in the auto market is, well, frankly, the inability to get inventory. So inventory has been a huge problem, and I'm sure that definitely is in a way impacting their bottom line just due to the increased cost of obviously importing and production that comes along with it. But that's just in general. But supply chain for them, I think, is the main issue as far as the EPS line concerned. That's what affects them. But again, the production and stuff impacts the suppliers, and therefore that gets passed on to someone like CarMax. Revenue came in at $7.99 billion, which is up 48.8% year over year. It's a beat by $1 billion. Massive beat, all things considered, and this is a fantastic line of revenue. This is record revenue for them for a quarter. They sold 419,895 units. The retail and wholesale channels up 19.9% from the prior year quarter. Retail used units increased 6.7% to 231,000. Comp store sale units increased 6.2% compared to the year ago. Wholesale units increased 41.4%. And gross margin came in at 10.2 versus an estimate of 11.9. That's where you see your EPS miss. And again, I think there's definitely reasons for it. During the second quarter, opened 3 new locations. Plan to open 10 new locations for fiscal year 2022. Worth mentioning there too. Let's just bust into this report and see what we got here. So obviously we saw the number of vehicles sold. Very nice. Record net revenues coming in at $8 billion. Beautiful stuff. They bought 364,000 vehicles from consumers, which is a 59% increase versus the year prior, which is good. They need inventory. Nothing wrong with that. 188,000 vehicles bought in the quarter were purchased from consumers through our nationwide online instant appraisal offerings. Kind of crazy. I mean, you put your car up online and they appraise it for you right there and you sell it. Personally, I don't believe necessarily the formula that they're going to give you a fair amount, but the dealer doesn't give you a fair amount either. You could trade in the year prior of the exact same vehicle with 10,000 miles on it, and they'll give you $500 for it. $500. Trust me, that's just all they do. They screw you. Gross profit per retail unit was $2,185. Not that bad. In line with historical performance, down slightly from the second quarter of last year. Not bad, though, all things considered. Wholesale gross margin came in at $1,005, $81 per unit decrease. So, again, that's where we see a little bit of that EPS hit there. CarMax Auto Finance income increased 35.9%. You like to see that. Higher net interest margin and increase in average managed receivables. Not too bad. And they say the EPS hit was due to COVID-related cost savings they did last year. I mean, you can blame anything you want on COVID if you want to. It's fair. So all things considered, I see a pretty darn good report here. I mean, again, they just get into some of the finer details here. Nothing is crazy here that I need to mention there. They repurchased $1.8 million of share in common stock. In the second quarter, that's quite a bit. $220 million of stock repurchase is really nice. You'd like to see that. And here's a nice chart of obviously used vehicles versus wholesale and how that's really changed on a 3-month and 6-month ending basis. Big changes, all things considered. It's big growth. It really is. Average selling prices have increased as well. You like seeing that. Used vehicles and used vehicle revenue definitely fell point in 2020, which made sense. But this year have shown good increases over the year prior, which is plenty understandable. Makes a lot of sense. Really does. So that's kind of it there. I'd like to look at the balance sheet on this company, and then we'll talk a little bit about the stock itself. Not one I've talked about a whole lot, if you might know. But here we have a comparison of year over year. It's what I'll do August to August. We'll do it. So right now, as of recent August, they've got $5.3 billion in total current assets. Very, very tiny cash position. This compares to last year when they had a massive cash position, understandably for the market at the given time. They've now turned that into more of inventory, which I get. So overall, you did see an increase in total current assets, 5.3 compared to 4.3 billion. Not too bad, all things considered. Total assets in general at 24.4 compared to 21.2. So we have seen an increase over a year's period, and I personally expect that, obviously, as you see recovery from some of the deficits that we saw last year, some of the downfalls and tailwinds, or headwinds, I should say. Now we've seen a little bit more of a benefit, so you're able to grow that balance sheet a little bit. Let's see what the liabilities look like. 1.9 billion in total current liabilities compared to 1.58. Not too concerning as they grew current assets by more. And total liabilities in general at 19.5 compared to 17.2. Again, not that concerning. Shareholder equity saw a rise around $1 billion, 4.9 to 3.9. It's pretty nice. One thing I have to say with the stock, look, you look at the valuation of this stock, and I think I'm a buyer in this stock right now. I think I am. This is a company, after today, likely trading at a losing 10% of the value. They're trading below a $20 billion market cap with a trailing 12-month revenue of $23.4 billion. PE ratio after today is going to be falling somewhere to the 16 range. This is a very dirt cheap stock, and I think there's a lot of room for growth here. And you look historically, I mean, the last 5 years, 144% growth already. This is a business that I think takes off in the future too, because you think about the fact that online car buyership it's going to go up. Online car sales will, but there are short-term issues right now, being that there are issues as far as inventory, which I get. But I think long-term, this stock is a fantastic buy at this point. You should buy this one if you're not in it yet, and if you're in it, I'd add more shares. I frankly would. I think this is a buying point that I really like, and it's probably something I'm going to be picking up this week. I don't know what the recovery period looks like, but that's what I got for you, and I hope you had a good one.